Now the next question that comes up is, when does the CISG apply? When should we apply the Convention on Contracts for the International Sale of Goods to a business transaction? Well, the CISG applies or will apply if three conditions are met. First of all, the contract is for the commercial sale of goods. The commercial sale of goods means that it is between merchants. So a private sale of goods is unlikely to be covered by the CISG. That is going to be covered by either domestic sales law or by the agreement of the parties, not by the CISG. Now the second requirement is the contract has to be between the parties whose places of business are in different countries. So there must be an international border in place between the two parties. And finally, the parties' places of business must be located in countries that have ratified the CISG. And again, although most major trading countries in the world have ratified the CISG, there are a few notable exceptions, including, or the most notable of which is the United Kingdom, which is a nation with a long and distinguished history of trading, of merchants. Napoleon once famously referred to England as a nation of merchants. He meant that in a disparaging way. But England has preferred to retain their own laws as the basis for transactions that they enter into, sales transactions. Nevertheless, most countries are members of the CISG. Again, 70 plus in the latest estimate. Now the CISG will not apply to every sale. There are sales that are excluded from the CISG. What are those? Well, first of all, consumer goods, meaning goods that are bought for personal, family, household use. Those are not the types of goods that are subject to the CISG. The CISG is focused on how merchants do business. Merchants being those in the business of buying and selling goods. So consumer goods are excluded from coverage by the CISG. Secondly, goods bought at auction. Intangible items, intangible property, things like stocks or securities or negotiable instruments, money, all of those things are excluded from the CISG. Large ships, vessels, aircraft, those do not fall within the CISG as goods. Electricity is not a good under the CISG. Not to say that all fuel sources aren't. Oil, the commodity of oil, is a good for CISG purposes. There are also other contracts that are excluded from the CISG, for instance, assembly contracts in which the goods are to be manufactured or produced, and the buyer is going to provide a substantial part of the material necessary for the production of the goods, meaning this is really a contract for the assembly, for the building of goods. Another contract that would be excluded is a contract that contains mixed provisions. There is a sale of goods aspect and there is a services aspect. In those cases, the court or the arbitrator will look to see what was the predominant part of the contract. What was the contract mainly for? One easy way to do this is to look at what were the relative costs of the contract. For instance, if Oklahoma State University decided to replace all of its chalkboards with dry erase boards, and it contracted with a company that was going to provide the dry erase boards, and they were also going to take charge of removing the chalkboards and installing the new dry erase boards. Now that's what we call a mixed contract. So to determine whether the CISG will apply to that contract, we look to see what is the contract, what is the predominant part of that contract. Is it the sale of dry erase boards, or is it the removal and installation of the chalkboards in favor of the dry erase boards? If the majority of the money being paid is for the installation, the labor, then that is not a goods contract under the CISG. That's a labor contract that's going to be governed by the common law if it's to take place in the United States. So in the United States, that contract between Oklahoma State and, say, a company based in China, that's going to be governed by the common law, not by the CISG. Now, if the numbers were different, if it turns out that 80% of the cost of the contract is the dry erase boards and only 20% is installation, then that would be in predominant part the sale of goods, and therefore the CISG would apply. The final aspect of the contracts that are excluded are those contracts in which the parties agree to opt out of the CISG, where they specifically decide that the CISG should not be the governing law. And the parties can do that. This is how the CISG works, is that the contract almost always controls the law to be applied to the contract. So if you and I enter into a contract, and you are based in Ireland, I am based in the United States, and we enter into a contract, and we agree that the laws of Ireland will govern our contract, then, and that the CISG should not apply, then the common law of Ireland will apply. Keeping in mind, however, the next case that we're going to discuss. We next turn to the case of Asante Technologies versus PMC Sierra. Now this case is interesting because it involves a contract in which the parties thought that the contract provisions were different than what they in fact were. Now in this case, the plaintiff, Asante, purchased electronic parts from a company based in Canada. So the purchaser is in the United States, the seller is in Canada. In both situations, the United States and Canada are both signatories to the CISG. Now, Asante purchased the products through a distributor also based in California. Now, the contract said that the law to be applied was the law of the state in which the seller was based. And Asante argued that from their perspective, the seller was the distributor based in California, and therefore the law of California should apply to the dispute. Now, PMC had issued a confirmation of the order from Asante. And in PMC's confirmation, they said that the contract shall be construed according to the laws of Canada. So we have what appears to be two different interpretations of the contract. The plaintiff believes the contract is going to be, the choice of law to apply to the contract is the law of California. The defendant believes that the law to be applied is the law of Canada. And the parties go to the court and they say, which law should apply? Is it Canada or California? And the court essentially says it doesn't matter because the applicable law in this contract is the CISG. And the CISG is the domestic law of Canada and the domestic law of California. Because of the supremacy clause, which says that treaties entered into by the federal government are supreme over domestic state laws, then when the United States ratified the treaty, the CISG became the controlling law in California for this question of the sale of goods in an international context. So the parties thought that they were trying to decide two different questions. Was it going to be the law of California to apply or the law of Canada to apply? But what the court said is it's the same law. It's the law of the CISG. So the CISG is domestic state law for those areas of the law that the CISG covers. For a contract, for the sale of goods between merchants across international borders. If those two countries have both ratified the CISG is the controlling law, regardless of the domestic state